How does shadow banking risk traditional banks? Imagine a busy financial world where not everyone plays by the same rules. Some entities act like banks but are not officially regulated. This is the shadow banking system. It includes money market funds, investment vehicles, and securitization channels that raise short-term funds to finance long-term assets. They do similar work as banks but without access to central bank support or deposit insurance. The trouble begins because shadow banks operate outside the strict rules that govern traditional banks. They can often lend money more cheaply or offer more flexible terms. This makes them attractive to borrowers and investors, pulling business away from regular banks. When traditional banks lose customers or profits, they might take bigger risks to stay competitive. Shadow banks also borrow short-term and lend long-term, just like banks do. But they do not have the safety net of central bank emergency funding or deposit insurance. If many shadow banks suddenly face funding withdrawals, they can collapse quickly. This can cause panic and market disruptions that spill over into the traditional banking system. Another risk comes from how closely shadow banks and traditional banks are connected. They often lend to each other, trade securities, or use derivatives contracts. If a shadow bank faces a crisis, it can cause losses for banks holding their securities or exposed through these contracts. This interconnectedness can spread problems fast, threatening the stability of the entire banking system. The shadow banking system is also less transparent than traditional banks. Its complex structures make it hard for regulators and banks to see where risks are building up. When a crisis hits, these hidden vulnerabilities can suddenly cause big problems. Looking at history, shadow banking has grown a lot since the 1970s. Back then, money market funds acted like bank deposits but were unregulated. By the time of the 1987 stock market crash and the 1997 Asian financial crisis, shadow banking had become a major part of the financial world. The 1987 crisis showed how problems in shadow banking could cause wider financial trouble. Today, shadow banking can challenge traditional banks by creating competition, increasing systemic risk, and making regulation harder. While shadow banks help keep credit flowing and provide liquidity, their lack of safety nets means that when they run into trouble, the effects can spread quickly. This interconnected web of risks is why understanding shadow banking is vital for keeping the financial system stable. It has shaped how banks and regulators think about risk and safety in the modern economy.